Good afternoon. Welcome to my accounting class, and I will be taking advanced taxation today. That is from the ICANN study pack. Those that are not accounting students that may come across this video, ICANN means the Institute of Chartered Accountants of Nigeria. So, advanced taxation is a course, is a subject in the professional level. That is the final level of accounting. So, we'll be taking one topic today that is called transfer pricing. Okay, so we have some subheading under the transfer pricing, but we'll be looking at only the introduction part of it and just one subheading under it, which is called advice on transfer pricing based on Organization for Economic Cooperation and Development, OECD, the guidelines. Because I don't want the video to be too long, so I will talk about just this on this video, and in another video I will go further to other subheading. Okay, so the topic here is transfer pricing. So the purpose of transfer pricing, okay, after studying this very chapter, okay, you should be able to understand the following, which are the subheading under it. Understand the provision of income tax transfer pricing, the regulations of 2018 that revoked the income tax transfer pricing regulations number 12012. Okay, you also have to be able to understand and apply the various laws on the assessment of companies. To be able to understand the various laws like their percentages, um, as at when they should not be taxed, like the turnover rate and all those rules and regulations, those laws. Number three, you have to identify related parties and transactions and their effect on total profits and assessment. Number four, you also have to understand, identify and treat appropriately transfer goods and services between multinational companies. Here we have number five, describe some transfer pricing guidelines and method by OECD. This OECD means Economic Cooperation and Development. Okay, so number six here, you have to understand the transfer pricing documentation process. Everything has a process, you need to know what to be in number one, number two, just like that. Know the step by step. You should be able to understand it after this chapter. Then number seven, note the differences between transfer pricing policy and transfer pricing compliance document. So number eight, know the content of transfer pricing declaration and disclosure forms as described by the Federal Inland Revenue Services, FIRS. Okay? Know the timing for filing of transfer pricing returns. And lastly, know the administrative penalty applicable to taxable persons that fail to comply with transfer pricing regulation. Okay, so these are the things you need to know and understand in this very topic under transfer pricing. Okay, so the introductory part of it now. Transfer price is the price charged for goods or services supplied or transferred by one subunit of an organization to another subunit, or one member of a group to another. Okay, like there is I think the place I did my IT, my industrial training, there is something they call back charging. One department will do one thing, somehow they have to back charge the other department. Maybe there is a department or there is a branch that have a particular item. This department can go there, take the item from that other department that has the item, bring it to their own side, use it, and you back charge. Or there is a department that handles the raw material while the other department is producing. When the producing section need raw materials, they goes to the other side to pick up the items they want, and they bring it here. At the end of the day, you make the payment back to them for the raw material you collected for the production of your finished goods. Okay, so that's the price. It is also referred to as the price of which an enterprise transfer physical goods and intangible property or provide services to associated enterprises. So, like I said, I use the example of department. Sometimes it may not be a department, it may be an associate company, or a subsidiary, some parent company. I don't want to call the name of company, but there are some big company. Everybody know the name. Then they re-register some other company under them, or they buy the shares of other company and they begin to um, be in charge of them because their amount of shares there is higher. Okay, so these are the associate companies. They always have something to do together. Okay, so with particular reference to multinational companies, transfer pricing is a mechanism used by the multinational to transfer goods and services between their related or associated companies worldwide. Okay. A transfer price may be determined based on the external market price or open market price for a similar product. Market based transfer price, or it may be based on the cost incurred in making the product, cost based transfer price, or it may be determined through negotiation between the subunit or members of a group buying and selling the product, negotiated transfer pricing. Okay, the rule for transfer pricing implementation in Nigeria is governed by the income tax transfer pricing. Okay, it's governed by the income tax. Income tax, same thing as the transfer pricing. Regulations of 2018. So, which replaced the income tax transfer pricing regulations number 1 of the 2012. Okay, that is transfer pricing was first of all done in 2012, but it was now modified in 2018. So the regulation of 2018 replaced the one of 2012. Okay, this implies that all through transfer pricing is not new in Nigeria, but the laws regulating it were first put together in 2012, which, as I told you before, it was first of all um, put together in 2012 and they were using it, and they saw the need to modify it in 2018 and they modified it, and the 2018 is now effective, overriding the 2012. So from the foregoing, transfer pricing refers to the prices. Okay, let me take this again, sorry. So from the foregoing, transfer pricing refers to the prices at which the following are transferred between connectable taxable persons. It's not everything that is taxable, you should know that already. Okay, so number 1, tangible goods. Tangible goods such as raw materials, spare parts, finished goods, etc. Number 2, services like marketing, legal, accounting, insurance, management services, training, and the last one here, intangible items like trademarks, uh, patent right, copyright, etc. I believe you should know what is trademarks, patent, the patent, and the copyright. If you don't know it, you can go and Google it and know it. I'm trying to make the video not to be too lengthy. Okay, so if I'm saying anything you don't understand, you can go and Google it, or you can ask me at the comment section. I can either make another video for that, or maybe can respond to you at the comment section also. So our subheading number 2 here is advice on transfer pricing based on Organization for Economic Cooperation and Development, OECD, the guidelines. Okay, the challenge for developing and trans the challenge for developing and transitioning countries in the development of transfer pricing legislation is in essence the same as for OECD countries. Okay, protecting their tax base, why not creating double taxation or uncertainties that could hamper foreign direct investment and cross-border trade. The adoption of transfer pricing legislation embodying the arm's length principle can be instrumental in achieving this dual objective. The suggested approach is based on the arm's length principle underlying Article 9 of the OECD model, tax conversion on income and on capital. The OECD model, always remember the meaning of OECD, Organization for Economic Cooperation and Development. Okay? Okay. Okay. The OECD model, as that principle is elaborated in the OECD transfer pricing guidelines for multinational enterprises and tax administration, the OECD transfer pricing guidelines. Okay, dozens of countries around the world have implemented transfer pricing laws, and virtually all of them are based on the arm's length principle. Arm's length principle, that is the price that both parties agreed on, that is arm's length. Okay, the price both parties agree on, the one selling and the one buying, and the one buying agreed to pay. Nobody was forced or biased or persuaded or whatever. Everybody is happy at the end of the transaction. So an agreement was reached and the item was purchased and was paid for. That is the arm's length. Okay. So with regard to transfer pricing of goods, technology, trademarks, and services between associated enterprises and their methodologies, which may be applied for determining correct prices, where transfers have been on other than arm's length terms. The contracting state will follow the OECD principle, which are set out in the OECD transfer pricing guidelines. This These conclusions represent internationally agreed principles, and the group of experts recommends that the guidelines should be followed for the application of the arm's length principle, which underlines the articles. Alignment of domestic transfer pricing rules with the internationally accepted principles set forth in the OECD transfer pricing guidelines can provide countries with the tools they need to fight artificial shifting of profit out of their jurisdiction by multinational enterprises, MINEs. Okay? So, this transfer pricing provides the multinational enterprises with some certainty of treatment in the country concerned. It reduces the risk of economic double taxation. These are the benefits of the transfer pricing. It provides a level playing field between countries, which is less likely to distort the pattern of international trade and investment, and provide a level playing field between the multinational companies and intended enterprises doing business within a country. So that is it for today. I believe you understand what is transfer pricing now, and the benefits of the transfer pricing, and the guidelines for the OECD, which is Organization for Economic Cooperation and Development. I hope you understand this now. You also know that transfer pricing um, are, are between connectable items.